Every day, billions of dollars move across global markets, not because of a single stock or currency, but because of mood. The collective mood of investors worldwide. That mood has a name. It is called risk on, risk off. And understanding it can change how you read every trade you consider. Here is the core idea. When investors feel confident about the global economy, they move money into higher risk assets, chasing better returns. That is a risk-on environment. When fear takes over, geopolitical tension, a financial shock, weak economic data, they pull back into safer assets. That is risk-off. Large institutions and funds do this constantly, rebalancing their portfolios as the outlook shifts. Those moves create powerful trends across currencies, commodities, and equity markets all at once. For Forex traders, knowing which environment is in play gives you context before you enter any trade. Certain currencies behave predictably in each environment. In risk-on periods, commodity-linked currencies tend to strengthen. The Australian dollar, the New Zealand dollar, and the Canadian dollar. Their economies depend heavily on global trade and commodity demand, so they rise when growth expectations are high. In risk-off periods, traders move into safe haven currencies, the Japanese yen, the Swiss franc, and the US dollar. These are backed by political stability, strong current accounts, or reserve currency status. The pair AUD-JPY is worth watching closely. When it rises, risk appetite is generally growing. When it drops sharply, that often signals a broader risk-off shift across the market. To track sentiment in real time, watch a few key indicators together. Global equity indices like the S&P 500 reflect overall confidence. Rising markets often mean risk-on conditions. Gold tends to climb in risk-off environments as investors seek safety. The VIX index, which measures expected volatility in U.S. equity markets, is another useful gauge. A rising VIX signals growing fear. A falling VIX suggests calmer, risk-on conditions. Now, a few mistakes to avoid. Do not assume sentiment moves in one clean direction. Mixed signals happen regularly, and forcing every market move into a simple label leads to bad decisions. More importantly, sentiment is context. It is not a trading signal by itself. Always combine it with your technical analysis and your risk management rules. Also, be careful during fast-moving risk-off events. Spreads can widen, price swings can become extreme, and impulsive reactions often lead to poor entries and larger losses than expected. Trading involves real risk. Only trade with money you can afford to lose. The practical takeaway is this. Each morning, before you look at any trade, spend a few minutes reviewing equities, gold, and major Forex pairs alongside the day's economic news. Over time, that habit builds the pattern recognition that helps you read the market's mood before it moves against you.